about the valuation of stocks. And just like we talked about in the previous two topics, we use the valuation method to value stock. And the idea of valuing stock is actually similar to valuing a project or valuing a bond, because we're just tracking down all the future cash flows generated from the stock, right? And then calculate the present value of the stream of the cash flows generated from the stock. Then we get the stock price. So this is the basic intuition. And we are using the kind of the fundamental method again, right? So to value the cash flows generated from the claim. Because stock by itself, it's also a claim, right? You buy the stock, now you have claim to a stream of cash flows promised by the company, right? And before we talk about the valuation of the stock, we're gonna first talk about the trading of the stock, right? Because why do we bother valuing a stock? Because we want to trade them. Because we trade the stocks in order to make profits, right? And if you own a company's shares, you are the shareholder of the company, right? And there are in general two markets where investors trade. The first market, the primary market, this is when the sales of shares happen, right, to raise new capital, right? In the secondary market, which is usually like stock exchange, most of trading happen, right? So most of trading in this company, which for example GE, take place on the stock exchange, right? This is a secondary market. In this secondary market, investors buy and sell existing GE shares or company shares, right? And NYSE and NASDAQ, there are two principal US stock exchanges. And apart from that, investors also trade on electronic communication networks, which is ECN, right? Nowadays, most of the trading actually happen in this ECN because this facilitates the speed of trading, basically. Now we're gonna talk about different kinds of orders, because when you trade, you will need to make orders, right? You either make the orders on your own on an electronic platform, or you instruct your broker to make these orders. And there are four main types of orders: market order, stop order, limit order, trading stop. Right? So we start from market order. Basically, market orders, they are buy and sell orders that are to be executed immediately at current prices. Right? So there's no kind of wiggle room that you can have. So as long as the price is current price, then the orders are kind of executed. That will be it, right? For example, a broker might report that the Facebook price to her client as follows, right? The best bid price is 118.34, and the best ask price is 118.36, right? So you have bid price and ask price. Now the investor would need to pay 118.36. So this is the ask price to purchase a share, right? And then they could receive 118.34. So this is the bid price, right? If she wished to sell. So remember, the bid price is the price that is acceptable for a dealer, for a buyer or dealer, right? So, and this ask price, this is the price that is acceptable for a seller, right? So only when you pay 118.36, then that will be acceptable for a seller, and that means you can actually buy a share, right? So buy a share from a seller, right? And if there's a market order, for example, in order to buy 100 shares, and the market would result in purchase at 118.36, right? And the order to sell at the market will be executed at 118.34, right? So this is what bid price and ask price means, right? So again, in order to buy 100 shares, this is the 118.36, right? So this is the price this is the price you have to pay if you want to buy a share, right? And then 118.34, this is the bid price, right? So this is when the price you have to accept if you want to sell at the market, right? So this is the market order. But there are many situations where if you place a market order, the market order won't be executed, right? Because there are too many investors who want that market price, right? So nobody, so you are in queue, right? So then after other investors are fulfilled, then the price already changes, right? So then your market order actually cannot be executed, right? This is a typical problem that happens when investors want to place market orders. There's three kind of complications. Like one of them is just like what I said, right? So there's three main complications. First one, the posted price quotes represent a commitments to trade up to a specified number of shares, right? So then another trader may beat our investor to the quote, right? So there are competing investors who actually compete for the price. And then the best price may change before her order arrives, right? So this may cause the market order to fail, right? So to fail means that this order cannot be executed, right? This is kind of idea. So that's why we have another type of order which is called limit order. And a limit order is a type of order to purchase or sell an asset either at or below or at or above a specified price. Right? So if you have a limit buy order, that will tell the broker to buy the number of shares if and when Facebook may be obtained at a or below stipulated price. Right? So or like the price you specified. Right? So I mean this is almost like asking a broker, I want to buy, I mean 100 shares of Facebook, but only when the price is lower than some range, lower than the upper bar. Right? So this kind of idea. On the other hand, a limit sell order instructs the broker to sell if and when the stock price rises above a specified limit. Right? So this is asking the broker, I want to sell 100 shares of the stock, right? But only when the price is above a certain level, the lower bar, right? So, and a collection of limit orders waiting to be executed is called a limit order book, right? So that collects the limit buy order and limit sell order, right? So this is a limit order. So you can see this provides investors the flexibility, right? So not at a single price, which is very hard to kind of reach, right? In a market where there are many investors competing for a price, right? For example, the market price is 100, right? So maybe I'm willing to accept. I'm willing to accept a limit buy order. Say I want to buy 100 shares of the Facebook stock, right? Whenever the price is, let's say, below 120, right? So I can always accept these orders. Now you have provided some flexibility for the order to be executed, right? You provide a range of prices. So then this makes your order easier to be executed, right? That's the idea. And let's look at some more concrete examples, right? For example, if a trader is looking to buy XYZ stock but has a limit of 14.5, right? They will only buy the stock at a price of 14.5 or lower, right? So this is a limit buy order, obviously. And if the trader is looking to sell shares of XYZ with 14.5 limit, that means there is a lower limit, right? So the trader will not sell any shares until the price is 14.5 or higher, right? Because when you sell, you always want to sell to a higher price. When you buy, you always want to buy at a lower price. That's the idea. Right? So and it, I mean, like I just described, right? So the limit order is in particular very useful when a stock is rising and falling very quickly, right? Because when a stock is falling and increasing very quickly, it is very difficult to get a market order through, right? Because the price is changing just so fast, right? And in that case, if the price is changing so fast, a trader is fearful of getting a bad feel from a market order, right? So therefore, limit order is very useful in these cases. And now we have a third type of order, which we call stop order, right? So stop order is an order to buy or sell a security when the price moves past a particular point, right? So again, we have buy and sell stop order, right? So a buy stop order is entered at a stop price above the market price, right? A sell stop order is entered at a stop price below the current market price. right? So let's look at an example just to make it clearer. An investor purchased AAPL, that's the Apple stock, right, for 145, and the stock is now trading at 175. Right? And then to limit any losses from a plunge in the stock prices, right? The investor places a sell order at a stock price of 160, right? So what does that mean? That means if an adverse event occurs causing AAPL to fall, the investor's order will be triggered when the prices drop to 160. Right? So this is the kind of idea. It stops the losses from becoming bigger. Right? So this is what it means, right? So again, the investor places a sell order at a stop price of 160. Right? So and then if an adverse event occurs causing the stock prices to fall, right, the investor's order will be triggered when the prices drop to 160. Right? So whenever the stock prices goes down to 160, then the kind of broker or the system will automatically execute this sale order, right? So at a 160. All right, so it's just that investors sometimes they are too afraid of stock price going down too fast, right? So they don't want to suffer from further losses, right? So they will specify a price, right? So below which the broker, the system will execute the sale order, will sell their shares, right? Basically. So this is a stop order, right? So the stop order basically kind of lock basically the losses if you want to place a stop loss order. Oh, sorry, stop sale order. Right? Now, finally, you can have a trading stop. And trading stop is essentially a special example of stop order, right? So it has some kind of flexibility over stop order. So the trading stop order is a type of order where the stop loss price is not set at a single dollar amount, right? So because in the previous example, it's set 160, right? So it's an absolute number. But instead, in trading, if you place a trading stop order, the price is set at a certain percentage or certain dollar amount below the market price, right? So in other words, it moves with the market price, right? So for example, suppose you buy a company XYZ for $10, right? So you don't want to lose more than 5% on investment, right? So what you can do is that you can take it, and at the same time, you want to take advantage of any price increases, right? So there, what you can do is that you can set a trading stop order that your broker will automatically sell if the price dips more than 5% below the market price. Right? So if the stock moves against you, right, the trading stop will trigger when XYZ hits 9.5, right? So again, it protects you from suffering more downside risk, protect you from losing more, right? But now if the stock goes up to 20, right, the trading stop will only trigger sale if the stock drops below 19, right? And now you can see this trading stop order actually moves together with the stock prices, right? So whenever the stock prices go to a level, the trading stop price will be like $1 below it or 5% below it, right? That will be it. So you can see this kind of trading stop order protects investors from losing more, and at the same time, they help investors lock the gains, right? So that's the idea. Okay, now we talk about different kinds of orders, right? Different kinds of trading orders that you can place when you actually buy or sell stock. Now we're gonna talk about two trading strategies, right? I mean, we actually heard on the streets quite often. The first type of trading strategy is called buying on margin. All right, so you all remember this film called Margin Call. All right, the margin call is a firm that describes there is a margin call on the Wall Street, right? So, and that happens to many investment banks before the financial crisis, right? So margin buying refers to the buying of security with cash borrowed from a broker using the bought security as a collateral, right? So again, margin buying refers to the buying of security with cash borrowed from the bank using the bought security as collateral, right? So it usually happens when an investor does not have enough cash to buy the stocks. That's why they borrow from the broker and use the stock as the collateral, right? So then in that case, you can almost predict what is the investor's mentality. The mentality is that the stock is going to increase, right? So then in the future, when you return to the broker, you actually can profit from the price increase, right? So this is the mentality of investors when they try to do margin buying, right? So and this actually increases the leverage of your transaction, right? So we will use example to show that it magnifies any profit or losses made on security. And the net value here, which is the difference between the value of the security and the loan, is initially equal to the amount of own cash used, right? So this is the net value. I mean, in other words, the net value here is a guarantee or is the ability of the investors to pay back the loan that they took from the broker, right? So now you can see what is margin call like, right? The margin call is essentially like if your net value, meaning your ability to pay back the broker, falls below some thresholds, there will be a margin call, meaning the broker will warn you because it seems that you won't be able to pay back the loan, right? So that's why this is when the margin call is triggered, right? And basically to protect the broker against the falling the value of the security, right, to the point that investors can no longer cover the loan, right? That's why this net value or this difference has to stay above a minimum margin requirement, right? So if this difference falls below a minimum margin requirement, there's a margin call, right? Simple as that. So let's look at one example. Jane buys a share in a company for $100 using 20 of her own money and 80 borrowed from her broker. Right, so then the net value here, which is the share price minus the amount borrowed, is 20. Right, so this is essentially Jane's ability to pay back the loan that she borrowed from the broker. Right, now the broker wants a minimum margin requirement of 10. Right, so in this case, you can obviously see Jane now has met the minimum margin requirement, right? Because the minimum margin requirement is $10. Now, suppose the share price goes down to 85, right? Now, the net value, the difference actually goes down. Right? The net value now is actually only $5, which is the previous net value of $20 minus the share's $15 drop in prices. Right? So this is the net value now. Right? Now you can see this will be a cases of margin call, right? Because the net value actually, or the difference between how much Jen has minus the stock she actually borrowed from the broker. The net value is only $5. It is below the minimum margin requirement of the broker. Right? So in that case, Jane has to increase the net value to $10 more, right? Either by selling the share or repaying part of the loan. Right? So this is when a margin call happens. So previously, we have been talking about the margin requirement as a dollar amount, right? But in other cases, there could be a percentage margin requirement, right? So what is the percentage margin requirement? That's usually the ratio of the net worth or the equity value of the account to the market value of the security, right? So this is a measure of the percentage margin. Again, it's a way to reflect the ability of the investor to pay back the broker. Right? Again, the key idea here is the net worth. Now, suppose an investor initially pays $6,000 toward the purchase of $10,000 worth of stock, right? And this $10,000 worth of stock is 100 shares at $100 per share, right? And then the investor borrows the remaining $4,000 from the broker, right? Now you can see what is the percentage margin here. The percentage margin is 60%, right? Because 6,000 divided by 10,000, right? So this is 60%. So this tells you that the ability of the investor to pay back the broker is like 60% of the total worth total wealth the investors has, right? Now, if the stock price goes down to 70 per share, right? Now the percentage margin changes, obviously, right? Now it changes to 3,000, right? This is the equity in the account, right? Divided by 7,000. 7,000 is the value of the stock, right? Because you still have 100 shares, right? But now the price is 70. So that's 70 times 100. That's 7,000, right? And then again, you borrow 4,000 from the broker, right? So that's why you have 3,000 remaining in the account, right? Now you can see the percentage margin is 43%, right? So if the broker wants to set a margin requirement, percentage margin requirement to 60%, then obviously in this situation, there's a margin call, right? So let's look at another example. So let's calculate, in this example, how far can the stock price goes down before a margin call, right? So suppose the maintenance margin, or in other words, the minimum margin requirement that can trigger the margin call is 30%, right? So in that case, we can calculate the percentage margin, right? So what is percentage margin here? That is 100 shares, right, times the price, right? This is the total wealth of the investor, right? Minus 4,000. 4,000 is how much you borrow from the broker, right? Now this is the net wealth, right? Divided by the total wealth you have, which should be equal to 30%, right? Now you can see the higher the price, the further away you are from the percentage margin, right? If the price goes down, then you are dangerous, right? You will be fall below the percentage margin requirement. So we can solve the price, and it will be equal to 57.14, right? So this shows that this is the minimum price. The price has to stay above in order to avoid a margin call, right? So as long as the price goes down below this level, there will be margin call. Huh? Now we're gonna show actually the magnifying effect of buying on margin, right? So let's see what is the situation here, right? So basically the idea is that investors, they can achieve greater upside potential. But on the other hand, they also suffer greater downside risk if they pursue this strategy called buying on margin, right? So supposing investors is bullish on FinCorp stock, right? So which is investors really think that the stock price of this company is going to increase, right? And current price is 100, right? So then suppose the investor has 10,000 bucks, right? And then the investor wants to invest in this stock, right? So the investor expectation is that this company stock will go up by 30% during the next year, right? So in that case, the expected rate of return is 30%, right? If the investor invested 10,000 to buy 100 shares, right? So this will be the expected rate of return, right? But this is expectation because the actual return could be higher, could be low, right? Now, assume that the investors increase the leverage, right? So increase the leverage by borrowing another 10,000, right? So by borrowing another 10,000 from the broker and invest, right? So then we also assume that there will be interest rate that the investor has to pay, right? If they want to buy money from, if they want to borrow money from the broker. The interest rate here is 9%, right? Now the question is, what is the investor's rate of return if the stock price increases 30% by the year end, right? Now, the rate of return here, if the situation is good, right? So which is the economy is as investors' expectation, right? The stock price goes up by 30%. In that case, this will be the rate of return, which is 26,000 minus 10,900 minus 10,000, right? So this 10,000 is how much you borrow from the broker, right? This 10,900, this is your interest payments. So this 10,900, this is the principal that you owe the broker plus the interest you have to pay to the broker, right? And then this is how much you start from, right? This this 26,000, this is the future value of your total investment, right? Because you start from investment of 20,000, right? 10,000 you borrow, 10,000 you own, right? Then the stock price goes up by 30%, right? So then the future value of your 20,000 is 26,000, right? So this is your rate of return, which is 51%, right? Which is a huge number, right? So you can see you actually magnify the rate of return, right? Because if you do not borrow anything, what is your expected return, right? That will be 30%, right? But now you can see the real return is 51%, which is much higher, right? Almost double, right? Now suppose the stock price goes down by 30% to $70 per share, which is the worst case, right? In that case, your rate of return will be disaster, right? So this is the future value of your 26. This is the future value of your 20,000 investment, right? This is how much you owe. This is how much you start from, right? So in that case, you can see the rate of return will be negative 69%, which is really disastrous, right? Now you can see if you pursue this margin buying strategy, you actually magnify the losses and also as well as the profits. Okay, a similar strategy investors sometimes pursue, and you actually hear this often as well, which is the short sale strategy. Right? So you can see the purpose of short sale, or the mentality of investors who pursue short sale is exactly opposite to margin buying. Right? So in margin buying, investors hope that the stock price or expect that the stock price is going to go up, right? But investors who pursue short sale, they expect the stock prices to go down, right? I mean, in other words, a simple sentence to explain short sale is that investors sell the stock that they do not own, right? So how do you sell stocks when you do not own it, right? You borrow the stocks from the broker, right? So this is kind of my idea. So then then at the end of the day, you have to return the stocks to the broker, right? So in other words, that is called closing out the position, right? So what are the steps here if you want to do short selling? First of all, you borrow stocks through a dealer, right? Because you cannot sell something that you do not have, right? Now after that, you sell the stock and deposit the proceeds and margin in the account, right? And then finally, you close out the position, which means you buy the stock and return to the party from which it was borrowed, right? So that's the idea. This is short selling. And basically, the short seller anticipates the stock price will fall, right? So that the share can be purchased later at a lower price than initially sold for. Right? So in that case, the short seller will reap a profit. And we're gonna explain how will this work, right? And the short sellers must not only replace the shares, but also pay the lender of the security any dividends paid during the short sale. Right? So this is where you pay back, you have to pay back everything. Right? Now let's look at one example. Suppose you are bearish on Dow Bomb stock, right? So which means you expect the stock price to go down in the future. Now the current price is 100 per share, right? And then you tell your broker to sell short 1,000 shares, right? Now suppose the margin requirement is 50%, right? So that means you must have other cash or security in your account worth at least 50,000 that can serve as margin on the short sale. Right, so let's look at the balance sheet here. Right? The assets, suppose you are the investor. The asset you have is the cash 100,000 plus T-bills 50,000. And the liability, you also have liability and equity, right? Liability and equity is you have short position 100,000, right? Equity is 50,000, right? So this 100,000 is how much you borrow from your broker, right? So in that case, the percentage margin is 50,000, right? Divided by the value of stocks you owed, which is 100,000, which is 50%, right? So again, you can see this equity here, this 50,000. This is This is your ability to pay back your broker, right? This is kind of idea. Now, suppose you are right, and this stock falls to $70 per share, right? So in that case, you can now close out your position at a profit, right? So in that case, to cover the position, you buy 1,000 shares to replace the ones you bought, right? But now you can see the cost of buying 1,000 shares now is much lower, right? Because I mean the stock price goes down, right? So the broker only wants the shares, right? They don't care how much you borrow, right? So they don't care how much they don't care the value of shares. They only care about the number of shares, right? In other words. So because the shares now only sell for $70, the purchase cost only $70,000, right? And because your account was credited for 100,000 when the shares were borrowed and sold, your profit is 30,000. Yeah, so this is your profit. And what is the profit here? The profit is actually equal to the decline in share price times the number of shares sold short. Right? So here, the number of shares sold short is 100,000. Oh, sorry, 100. Right? So that's why this is the profit that you can earn from short selling strategy. Now, similarly, we can calculate how much should the price be, right? How much can the stock price rise before a margin call, right? Because opposite to margin buying, here the price increases are bad news, right? Because if the price increases, that means you have to pay more to pay back your broker, right? This is kind of idea. So again, we suppose the maintenance margin is 30%, right? Now we calculate the percentage margin. What is the percentage margin? It will be 150,000 minus 1,000 times P. So 1,000 is number of shares, P is the price, right? And what is 150,000? This is the total balance sheet you have, right? The total wealth you have, right? Out of the total wealth you have, this is how much you borrow from a broker, right? And then of course the remaining ones is your guarantee or your collateral for paying the broker. Right? It will be equal to 30%. And then you can see the price has to be below 115.38. Right? So if the price goes above that level, there'll be a margin call, right? Because your maintenance margin falls below that amount, that percentage. Now we have finished talking about the trading part, right? Now we move on to talk about the valuation. So valuation is actually a pretty important component of corporate finance, because if you do a merger acquisition, if you buy assets, if you buy the stocks, right? So you always want to conduct valuation, right? This is helping you to gauge the price you have to pay. Now you don't want to overpay, you don't want to pay less, right? So this is kind of idea. So the kind of first kind of analysis of valuation is called fundamental analysis, right? These fundamental analysis models, they base value on current and future probability, right? So it also identified a mispriced stock relative to measure of true value derived from financial data. Right? So this is fundamental analysis. And in general, we have four kinds of models: balance sheet models, PE ratio, dividend discount models, free cash flow models. Right? So balance sheet model is just looking at the balance sheet items, right? PE ratio is you compare the price earnings ratio with the company's peers, right? So there's a comparable peers group based on which you compare your companies to. Right? This is kind of the idea. And then the dividend discount model and the free cash flow model, they are objective models in a sense, right? Because they calculate the present value of the cash flows generated from the company. Now we start from balance sheet models. So what is balance sheet model? Basically, to look at the book value, right? Book value is the net worth of the company as reported in the balance sheet, right? And basically, the book value is the original cost of acquisition less than adjustment or depreciation, even if the market price of the asset has changed over time, right? And book values that are based on original costs, market values measure the current values of assets and liabilities, right? So in other words, book value, I mean, this balance sheet model, book value is very useful when there are no market values that you can use to value assets, right? I mean, think about like price to earnings ratio, right? If you use price to earnings ratio as a valuation method, you need to have a price. I mean, that's the basic idea. If you want to use like free cash flow model, you also need to have a market value as a benchmark, right? Because you are when you value some of your assets, there got to be a market value, right? For example, patents. For example, the company you buy, there got to be a market value out there. But there are cases where there's no clear market value there, right? And basically, if you use book value, like land, buildings, vehicles, machinery, they can indicate possible liquidation values, right? So there's one example where this balance sheet model is quite useful, because for public firms, in most cases we actually use like free cash flow or discounted cash flow model or P/E ratio model to value a company. There are cases where balance sheet model is quite useful, right? Because these cases are situations when there's no clear market value out there, right? For example, a couple of years ago, actually not very long ago, like 5 or 10 years ago, there are many enterprises or private enterprises in China, even like a state-owned enterprises in China. And what they do is that they buy lots of real estate, right? Because at that time there was real estate boom in China, right? So they hope that the real estate prices are gonna go up in the future, right? So they can make profits from the real estate appreciation, right? Because at that time it has been very difficult to run businesses, right? To actually do their main to operate their main businesses, right? So that's why they buy lots of real estate in order to make profits from the sale of the real estate, right? So in that case, you can see there's no market value for these kind of enterprises, right? So what is the market value of like an enterprises that has like 80% of assets are comprised of commercial real estate? You cannot find a really good market benchmark for it, right? So in that case, a good way to kind of value this company is use the book value or use the balance sheet model, right? What is the cost of buying these real estate, right? So this is a way to value this kind of company. Although this method is not very common in like more developed capital markets like US or like European markets, right? And the second one is the P/E ratio. And the P/E ratio method is actually one of the valuation by comparable methods. Right? So basically the idea is to compare the valuation ratios of the firm to industry averages. Right? So here, for example, if we use the P/E method, we compare the P/E ratio to the company's peers. This is kind of the idea. And ratios like price to sales are very useful for valuing startups when those startups they still haven't generated any positive earnings, right? So there are different kinds of valuation ratios, right? Depending on what kind of company you're looking at. So this is one example where we present P/E ratio and the P/B ratio. So P/E ratio is price to earnings ratio. P/B ratio is price to book ratio. Right? So we compare these two valuation ratios across four kind of industry peers or 4 big companies. Right? And for each company, we compare the P/B ratio to its peers. Right? For example, for Dow, we compare the P/B ratio to BASF, DuPont, and PPG. Right? For let's say Devon Energy, that's an oil gas company, we'll compare will compare the PE and PB ratio to its peers as well, right? So now you can see if you compare Dow to its peers, right? So you can see Dow's P ratio is relatively low, right? It's actually the lowest among its peers, right? If you compare this one. Now, if you compare the PB ratio, it's no longer the lowest, right? The average is 13.4. Dow's PB ratio is 2.3. The PE ratio is 14, right? So if you compare the PE ratio, Dow's PE ratio is highest, right? But the PB ratio, it is lower than the industry average, right? So that's the idea. So Dow's PE is in general higher than the PEs of the comparables. Well, in other words, the industry peers, right? So that share similar businesses, similar products. And then if we use the P ratio to value Dow, the price will be underestimated, right? Because P ratio is higher, right? If we use the PB ratio to value Dow, the price will be overestimated, right? So let's see what happens here, right? So if we use the P ratio of Dow is higher, right? If you use the PB ratio, Dow's PB ratio is lower than the industry average, right? So in that case, the price will be overestimated, right? So, so these are some kind of problem with using this valuation comparable, which is if you change another valuation ratio, your conclusion might be different, right? So that's one of the problems people usually have when they use valuation ratios. So that's why in many cases, investors actually use more complicated, more sophisticated ways to compare the comparable, right? For example, you can run a regression to control for other factors, right? To have a more precise estimate of P/E ratio across different companies. And another problem with P/E ratio is that for newly established startup from companies, this P/E ratio might be useless, right? Because they haven't established a meaningful market price yet, right? So, and also for those startup companies, that they usually will suffer consecutive years of negative earnings, right? I mean, what's new, right? I mean, high-tech startups, they usually suffer losses, right? Think about Uber. They suffer from losses for a couple of years before they start to make profits, right? Because the initial investment of technology is huge, right? That's the idea. Now, using the valuation model, the purpose kind of valuing stock is try to find the intrinsic value of a company. Now, then we need to differentiate between the market value and we need to differentiate between the intrinsic value and the market price, right? Basically, the dividend discount model and the free cash flow model, the basic idea is that the return on a stock is composed of dividends and capital gains or losses, right? Basically, when you buy a stock, there are two ways you can make profits. One way is that you receive dividends, right? So this is the dividends you receive from the company, right? The second way is that you buy the stock and sell it, right? So there will be capital gains, right? Of course, if the selling price is lower, you suffer from losses, right? But these are the cash flows from holding a stock. So in that case, the expected holding period return may be more or less than the required rate of return, right? This is kind of like, so what is the required rate of return? This actually goes back to topic 1, right? What is the required rate of return? That is the opportunity cost of capital, basically, right? And depending on the stock's risk profile, this expected holding period return could be more or less than the required rate of return, right? This is kind of idea. Now let's look at more concrete examples. So basically, if you own a share of common stock, the future cash flows will be future dividends per share that the company will pay out. All right, so this is the kind of idea. So now the capital gains or losses, we will think the capital gains or losses, they are also part of the dividends, right? because the future dividends already include that kind of capital gains or losses, right? So which we'll explain here. That is the present value of a share of stock equals the present value of one of the expected future dividends, one share of the stock. So why is that the case? So because the expected return here, how do you calculate the expected return? By holding a stock. If you have suppose you own a stock in period 0 and sell it at the end of period 1, right? So what is the expected return? It will be equal to the dividend you get plus the selling price, right? Minus the original price that you buy the stock, right? Divided by the original price, the current price, right? Now the price, this is the expected return, right? So what is the price? The price will be equal to dividend you receive plus the selling price, right? Divided by 1 plus K. Right? So that will be the idea. So this is when the present value of the share of stock equals the dividend you receive plus the capital gains or losses, right? So and then discounted to the present, right? So this is basic idea. Now we use a discount model. We use a discount rate to discount the cash flows, right? Because I mean, in our simple case, we have a 1 period, right? And what is the discount rate here? The discount rate here is the market cap rate or cost of equity capital. Right? Remember in topic 1, we talk about cost of capital. Here, we are talking about the cost of equity capital. Right? And this discount rate captures the expected return on other security with the same risk. So remember, in topic 1, when we say we use a discount rate to discount the cash flow, we say that this discount rate captures the expected return of cash flows that share the similar risk. Right? So that's the idea. And all stocks in this risk classes have to be priced to offer the same expected rate of return. Right? This is kind of idea. Now, we talk about required rate of return, right? Then how do we derive this required return? We use this model called capital asset pricing model to give us the required return. And what is this model? Basically, we will talk about this model in next topic. Here, I'm just gonna give you a brief overview. Basically, this model gives you or describes the relationship between the required return of a company and the market risk premium, which is the expected market return minus the risk-free rate, which is like usually the safe return you can get from investing like treasury bills, right? Which is almost riskless, right? So again, this one gives you a benchmark, which is the required return. This required return can be calculated by just using this beta, right? Beta is the sensitivity of the stock to the market risk, right? So the required return will be equal to the risk-free rate plus beta times the market risk premium, right? And if the stock is priced correctly, the discount rates we use here will be equal to the expected return or the required rate of return. So essentially, the required rate of return should be equal to the expected return if the stock is priced correctly. And an underpriced stock will provide an expected return greater than the required return. Right? That is, holding the stock actually gives you more than required rate of return. Right? So suppose we have risk-free rate 6%, market risk premium 5%, and a beta is 1.2. In that case, we can calculate the discount rate, which is equal to 12%. This is kind of idea. Right? Now, this is how we calculate required rate of return, right? Just using the CAPM model, which we'll explain next topic. And the idea is that when we use those valuation model, we want to compare intrinsic value and the market price, right? The intrinsic value here is the true value according to your model, right? Basically, it is the present value of all cash payments to the stockholder if the investor hold one share of the stock, for example, right? And these all cash payments include dividends as well as the proceeds from the ultimate sale of the stock, right? Capital gains or losses, right? And then these cash flows are discounted at appropriate risk-adjusted interest rate K, or in other words, discount rate or required return. Right? So this is the intrinsic value of a company, right? And what is the market value? Market value is just the price you see every day, right, on the stock market. What is the stock price? Stock price is essentially the collective judgment of all market participants of a future value of a company, right? So now when you find that the intrinsic value of the company is greater than the market value, that means the company is currently undervalued, right? Because the market participants' judgment is less than the intrinsic value. So there could be some private information, there could be some risky innovation projects that investors do not recognize the value, right? Which causes the undervaluation of the company currently, right? In that case, investors should buy it, right? If the intrinsic value is lower than the market value, then investors should sell it, right? If they're equal, then that means the company is basically fairly priced, right? Market recognizes all the intrinsic value of the company, right? Now let's look at one example here. Suppose this company ABS or ABC has expected dividend per share as $4 per share, right? And then for this company using a 1-year investment horizon and a forecast that the stock price will be 52 after a year, we can calculate the intrinsic value, yeah? Which is the intrinsic value here is P0, right? Which is the cash flows from the from the dividend and also the ultimate sale price 52, right? Which is 56, right? Divided by 1 plus K, which will be equal to, suppose the intrinsic value is 50, right? So suppose we already get the answer, right? So in our case, we can solve the required rate of return. If the intrinsic price is 50, that means the investor will derive a 12% rate of return, right? And then this 12% will be equal to the required rate of return, right? Right. So in that case, that will be fairly priced, right? Because the expected return equals the required return, right? So that means the company is fairly priced. However, if the current price is 48, in that case, the stock is underpriced. Why? Because I mean, first of all, the current price is lower than the intrinsic value, right? And also, if the current price is 48, the expected return should be higher than the required return. That means the company is undervalued, right? So on the equilibrium, the current market price will reflect the intrinsic value estimates, right? And in that case, the market consensus value of the rate of return should be equal to the market cap rate. I mean, that's just another name for this discount rate. Now we have talked about this simple one-period model where the price or the value of the stock will be equal to all the present value of all the cash flows generated from holding the stock, right? Now we're gonna provide some formal definition of it, right? So if we extend the horizon from one period to many periods, right? Then the price of the stock in this period will be equal to, the P1, that is the stock prices in period 1 will be equal to the present value of the cash flows starting from period 2, in period 2, right? So in that case, what are the cash flows? That will be the dividend you receive in period 2 plus the ultimate sale price in period 2. Right? Now P0 will be equal to, again, that is the present value of the cash flows, right? You receive in period 1. And what is P1? P1 will be this one here, right? And then and then we can take P1 plug into this equation here, we get this one. Now you can see we can do this game forever, right? So P2 will be equal to dividend 3 plus P3 divided by 1 plus K. So each period's stock price will be equal to the present value of the cash flows you receive by holding the stock for 1 period, right? Now if we have H years, like if the horizon is H years, then we can write down the stock value as the present value of dividends over the H years, right? Plus the ultimate sale price PH. Right? So if you have H periods, the PH is the ultimate sale price in year H, right? It will be similar to the bond valuation formula, right? Because you can see when we value a bond, that's also the present value of all cash flows generated from the bond. In that case, that will be coupon payment. Here is the dividend, right? But the key difference here is that in the case of a stock, you don't really know the future prices, right? And you also have the uncertainty of the dividends, right? And also there's no fixed maturity date. You can sell the stock at any time. There's no obligation you have to fulfill in order, in terms of when to sell it, right? So if we have many periods, like infinite horizon, we can write down this equation, D1, D2, D3. That is the present value of all cash, the present value of all future dividends in the future. Now remember, there's no PH here because every price will be written as the present value of the next period dividend plus next period price, right? So you can write on this formula into infinite horizon. Right? So this is what we call the discounted cash flow formula, discounted cash flow equation. This was derived on the assumption that price in any period is determined by expected dividends and capital gains over the next period. Right? So this is based on that kind of key assumption here. And at the same time, the capital gains also reflect dividend forecast at the time the stock is sold. Right? So it is incorrect to say that the value of a share is equal to the sum of a discounted stream of earnings per share, right? But what is correct here is that the share value should be equal to the discounted stream of dividends per share, right? Because I mean, it only depends on the cash flows that is generated from holding the stock, right? I mean, if it's earnings, right? Investors, they don't receive earnings; they only receive dividends, right? Although dividends come from part of the earnings, right? If they are earnings, part of them they are paid out to shareholder, part of them they are reinvested, right? So this one we will explain it in a bit. And one kind of shortcomings of this model is that although mature companies generally pay cash dividends, but some of the companies they don't pay dividends, right? So that's why for this company, you cannot really naively think that you can calculate the price in this way, right? Because they just do not pay dividends, right? That would be the idea. So this is one of the caveats. And it also depends on different stages of the company, right? So a growing company, they will maximize value by not paying the dividend to shareholder, right? They want to invest all their earnings into potential projects that can deliver good growth opportunity, right? On the other hand, the company can also pay out cash by repurchasing the shares from a shareholder. So this we will explain later in the class. So in that case, if the repurchase of the share is irregular and unpredictable, in that case, dividend discount model can fail. Right? They cannot really describe the price. Right? Now, we can further simplify the dividend discount model. Right? So you can see in the infinite version of this valuation model, right? You have to know the dividend in each period, right? And we can simplify the equation by assuming that dividend has a growth rate, right? So that we have a simplified equation. So now you can see we assume that the dividend grows at a growth rate G, right? Now you can see the first period dividend is D0 times 1 plus G. The second period dividend is D0 plus 1 plus G squared, right? Now simplifying this equation, we can get P0 will be equal to D1. This is D1, right? Divided by K minus G. Right? This is simple algebra. Now we have this equation, right? So price of a company will be equal to the next period dividend divided by the difference between market cap rate and the growth rate, right? And reorganizing this equation, we will get the market cap rate or the expected return will be equal to the dividend yield, right? Dividend yield is the first period dividend divided by price, right? Plus the G, right? So expected rate of growth in dividends. Now this is the dividend growth rate, right? So this is the constant growth DDM, which has more kind of wide use because it simplifies the dividend process, right? We don't have to know the dividend each period, right? We just need to assume there's a growth rate, right? So this is a numerical example that you can use the formula to calculate. Now let's take a break and then we will come back. Okay, so we're gonna continue. So let me first clarify one thing. So let's go back to here. So here we say that the future cash flows to the owner of a stock are the future dividends per share that the dividend will pay out. Right? So it seems to contradict here, right? So I mean, this is obviously price equals the cash flows next period, which includes the capital gains, right? But the point is that the price each period will be equal to the dividends next period, right? So that means even the prices already reflect the future dividend forecast, right? So this is already emphasized here when we look at this infinite horizon, right? So you can see if we have infinite horizon, each period's price could be written as the dividend forecast, right? So that means ultimately the price will be the expected, the present value of the expected dividends in each period in the future, right? So this is also emphasized here, right? So let's see here. Right, because when we write down the price here, right, this already is the dividend forecast next period, right? So here, right, so this emphasized here. The price in any period is determined by the expected dividends and capital gains over the next period, right? And then this capital gains here actually already reflect the dividend forecast at the time the stock is sold, right? So that's why we have this kind of idea, right? So the price of a stock will be equal to the present value of the expected dividends in the future, right? So that's kind. Now, the application of this constant growth DDM is it is often used in like rate hearings for regulated public utility, right? So because these public utility, right, they are regulated and they are pretty stable, right? I mean, they just pretty much provide electricity, water every year. So it's pretty stable business, right? And the regulatory agency responsible for approving utility pricing decision is mandated to allow the firms to charge just enough to cover cost plus a fair profit, right? And then how do we determine this fair profit? We can use the constant growth DDM, right? I mean, the reason why we can use this constant DDM is that because this kind of utility company, they are pretty stable, right? So you can realistically assume that their dividends follow a growth rate, right? And this fair profit is also a nice assumption because that is just required return on their business, right? Which is consistent with investor expectation, right? And we can use this market cap rate, right? Which is the dividend yield plus the dividend growth rate, provide inferences on the required return. Right? Now, suppose you want to estimate the cost of equity for cost of equity capital, for example, for this gas company, right? And then the stock was selling for 14.43 per share at the start of 2015. And we expect the dividend payments for the next year will be $2 per share, right? So in that case, the dividend yield will be 4.1%, right? Now, we still need the dividend growth rate, right? The key thing here is how to estimate dividend growth rate, right? So there are in general two ways, right? The first one is to rely on the views of security analysts, right? Because these kind of guys, they study the prospects of the company. So they will provide a forecast, right? So in that case, we can use the forecast like 7.7% and calculate the market cap rate or the required return. That's one way. The other approach is to estimate the dividend growth rate from the fundamental financial characteristic of the firm, right? So basically, we need to estimate long-term growth from the payout ratio, right? So what is the payout ratio? Payout ratio is essentially the ratio of dividends to earnings per share. Right? So basically, out of the earnings, how much is paid out to shareholder? How much is reinvested